Imagine for a second, right, that you are running this massive business
Okay, I'm picturing it.
and you basically print nearly $3 billion in cold, hard operating cash in just 90 days.
Which is just a staggering amount of money, by the way.
It really is. So you walk into the boardroom, you drop these picture-perfect financials on the table, and you beat every single consensus estimate that Wall Street threw at you.
A completely clean beat.
Exactly. And how does the market respond? They immediately wipe over $20 billion off your company's valuation.
Yeah, just brutal.
Welcome to the Deep Dive, where we take the absolute fire hose of earnings data, financial news, and these structural market shifts, and we distill it all into the signals that actually matter for you. Today, we are really focusing our lens on a massive dislocation in the market. We're doing our Talk Tickers segment, and we're breaking down the Q1 fiscal 2026 earnings call for Adobe.
Ticker symbol ADBE.
Right. And we really have to address this glaring disconnect right off the top, because management came to this call with just absolute bullish energy.
Oh, they were so confident.
Yeah, printing a flawlessly clean beat on the headline numbers. But the verdict from the trading floor was, well, it was swift, it was brutal, and frankly, completely unforgiving.
It was an absolute bloodbath in the extended trading session. You really rarely see a legacy software titan with this kind of entrenched moat post-record cash flows like that. I mean, they beat expectations on both the top and bottom lines, and then you just watch its stock absolutely crater by nearly 8%, and on massive panicked volume too.
It's wild. It kind of forces you to ask whether we are looking at a structural mispricing event, like a pure market overreaction, or if this is a massive vote of no confidence from the institutional money that actually moves the needle.
Right. And that's exactly what we need to figure out today.
Which brings us to the central mystery we're unpacking for you today. How does that happen? Like, how do you mathematically win the quarter, but psychologically lose the market that badly?
It's the million-dollar question. Or, well, the $20 billion question in this case.
Seriously.
Yeah.
I was staring at these numbers last night, and this analogy just popped into my head to kind of frame this for you. I know it sounds like a bit of a cliche, but think of this specific earnings print as a duck gliding across a very calm pond.
Okay, I like where this is going.
Above the surface, it's smooth, it's elegant, the trajectory looks completely under control, and those are your headline financial metrics.
The stuff the algorithms read first.
Exactly. But if you put on some goggles and look underwater, you see the actual mechanics. That duck is paddling furiously, chaotically, its webbed feet just churning the water to survive.
A great visual.
Thanks. Because underneath the surface of this Adobe print, we have this sudden and highly disruptive CEO succession. We have their core legacy products actively being cannibalized by artificial intelligence. And, we're witnessing a very messy, highly friction-filled shift in how they actually monetize you, the user.
Yeah, that framework is highly effective because it separates the algorithmic trading from the fundamental investing. Like, the surface level numbers are what the computer algorithms trade on in the first 5 seconds after the press release hits the wire. But the human analysts, the portfolio managers, the institutional whales...
The guys writing big checks.
Exactly. They are exclusively looking at the turbulence underwater. And in this current macroeconomic market, which is just hyper-fixated on the deflationary disruption of generative AI, any turbulence in the water is treated as a fatal flaw.
Not just a headwind, but a broken business model.
Precisely.
So, before we figure out why the market panicked and started aggressively hitting the bid in the after hours, we really need to establish the baseline for you. We have to examine the surface of the pond to understand exactly what Wall Street chose to completely ignore.
We have to give Adobe credit where credit is due on these headline numbers.
We do. Let's start with the top line because they were undeniably strong. Q1 FY 2026 revenue hit $6.40 billion.
That's billion with a B?
Right. That is up 12% year over year, or 11% if you adjust for constant currency fluctuations. And that cleanly beats the consensus expectation, which was sitting around $6.28 billion.
And it is crucial to understand that this wasn't just the top line squeak by driven by some weird accounting trick. The bottom line was equally robust.
Let's get into the EPS, the earnings per share.
Yeah, so non-GAAP earnings per share came in at $6.06. That is a very solid 19-cent beat over the $5.87 expectation that the sell-side analysts had modeled out.
Now, for those of you wondering why we specify non-GAAP here, GAAP stands for Generally Accepted Accounting Principles, right? It's the strictest standard of accounting.
Right, and their GAAP EPS was $4.60.
So why does Wall Street prefer the non-GAAP number here?
Well, Wall Street often prefers to look at non-GAAP numbers for tech titans like Adobe because it strips out massive non-cash expenses, primarily stock-based compensation.
Ah, right. Paying the engineers in stock.
Exactly. When you pay your developers in company stock, it dilutes the shareholders, sure, but it doesn't drain your actual bank account. By looking at the non-GAAP numbers, investors get a much clearer picture of the actual cash-generating power of the core business operations.
And speaking of cash-generating power, I mean, this is where Adobe usually just completely silences the bears. They posted record operating cash flow for a Q1 at $2.96 billion.
Let's that sink in for a second.
Nearly $3 billion in cash generated in roughly 90 days. It's wild. Their GAAP operating margin was 37.8%, and their non-GAAP operating margin came in at an incredibly impressive 47.4%.
Let's contextualize that 47.4% margin for a moment, because it is the defining characteristic of elite software as a service, or SaaS, businesses.
It's the whole reason investors love SaaS.
Right. Because if you are selling a physical product like cars or iPhones, every new unit you sell requires you to buy more steel, more glass, more microchips.
Your margins are capped by physical reality.
Exactly. But when you are Adobe selling digital subscriptions to Photoshop or Acrobat, the cost of duplicating that software and delivering it to a new user is practically zero.
So a 47.4% operating margin at a 6.4 billion quarterly revenue scale means almost half of every dollar coming in the door flows straight to the bottom line as operating profit.
It is a level of software leverage that 99% of companies on Earth can only dream of.
And they are aggressively deploying that cash, too. They aren't just letting it sit there in treasury bills. They repurchased 8.1 million shares in the quarter.
Which is a massive buyback.
Right. By buying back their own stock, they reduce the total number of shares in existence, which mathematically increases the value of every remaining share you might hold in your portfolio.
Right.
And they still have $3.89 billion remaining on a massive $25 billion authorization they put in place back in March of 2024.
It's a huge floor for the stock price, usually.
Usually, yeah.
Yeah.
Then, you have to look at the lifeblood of the entire SaaS model annual recurring revenue,
Yeah.
or ARR. Total ending ARR reached $26.06 billion, growing at 10.9% year over year.
ARR is the holy grail metric for these companies because it represents predictable, compounding, locked-in revenue. It is the exact opposite of relying on, say, one-off holiday sales.
So if we break down that 26 billion ARR into their specific customer segments, the momentum really appears entirely intact on the surface.
Yeah, let's look at the business professionals and consumers segment. This includes high-volume tools like Acrobat and Adobe Express. They called in $1.78 billion in subscription revenue, which is up 16% year over year.
Then you have the heavy hitters, right? The creative and marketing professional segment. This is your classic Creative Cloud, Photoshop, Premiere Pro, Illustrator, After Effects, the tools that entire industries literally rely on to function.
The industry standard.
Exactly. That segment brought in $4.39 billion, up 12% year over year. So by every traditional SaaS metric we use to evaluate the health of a software business, this was a pristine, healthy print.
Which makes the tape reaction so incredibly jarring. We have to walk through the immediate after-hours timeline because the repricing of risk was violent and, frankly, immediate.
Walk us through that tape, because it happened fast.
The stock closed the regular trading session around $269.78. It was on solid footing. But the moment these numbers hit the wire, paired with the qualitative commentary from management, the floor completely gave out.
It wasn't just a slow bleed.
Not at all. By roughly 5 p.m. Eastern, right as the executives were starting their prepared remarks on the conference call, the stock had slid down to around $251.97.
Wow.
That is a 6.7% drop while the CEO is literally speaking on the call.
And the selling pressure didn't stop there, right? It wasn't a quick dip that got bought up by the algorithms?
No, it kept going. By 7:59 p.m. Eastern, right at the final bell of the extended trading session, the stock was trading around $248.74.
So that's a total drop of about $21.04 per share.
Yeah, or negative 7.8%. And the volume of shares being dumped was just staggering. Regular session volume was tracking between 8.9 and 10.6 million shares, which is already elevated compared to their recent daily average of about 6 million.
But the after-hours turnover was incredibly heavy, indicating that large institutional holders were actively unwinding their positions, like they were hitting the exits hard.
Exactly.
Let's pause and really challenge the math here, because I want you to really think about the internal logic of this market reaction. If a company is beating the top-line revenue estimates by $120 million
Right?
and beating the bottom-line earnings by almost 20 cents a share, while actively buying back 8 million shares to support the price, what in the internal plumbing of these numbers is leaking?
Because you do not drop 8% on record cash flow unless the market fundamentally believes that the cash flow is about to permanently break.
Exactly. That is the crucial insight. The market is a forward-looking discounting mechanism. They do not care about the record $2.96 billion in cash flow generated over the last 90 days. They care deeply about the stability of the revenue streams over the next 90 months.
If they believe the moat is breached, past performance is completely irrelevant.
Right. And that brings us directly to the first major leak in the plumbing. The biggest shock of the call wasn't a missed financial metric at all. It was entirely qualitative.
The bombshell.
The catalyst for the drop. And we are moving away from the spreadsheets and stepping right into the boardroom now, because this single announcement completely overshadowed the earnings beat and essentially shattered the market's trust in the near-term narrative. Shantanu Narayen, the CEO of Adobe, is stepping down.
18 years at the helm, 100 consecutive earnings calls.
It's an epic, historic run.
To put that into perspective, he took the CEO role in 2007. That's before the launch of the iPhone App Store. That's before the great financial crisis.
He has been the primary architect of some of the most successful, most painful, and honestly most brilliant software transformations in the history of Silicon Valley.
Absolutely. We are talking about the man who dragged Adobe kicking and screaming from selling expensive software in shrink-wrapped boxes at Best Buy to a purely cloud-based subscription model.
Which was so controversial at the time, that transition destroyed their revenue for a few years, but it built the $26 billion ARR juggernaut they have today.
And now he is attempting to move the company from that cloud era to the AI-enabled workflow era. But right in the middle of that transition, he announces he's leaving the driver's seat.
He will remain board chair once a successor is named, working with lead director Frank Calderoni and a special committee on the search. But still.
If we pull back and look at the broader software landscape, you have to understand why Wall Street recoils at this specific announcement at this specific time.
It's the worst timing.
It really is. This is not just an operational handoff. It is a massive injection of governance risk at the absolute worst possible moment. The entire software sector is under immense structural pressure.
We've been tracking this AI scare trade for quarters now on this show.
Right. This is the pervasive fear among institutional investors that generative AI is going to compress pricing power and destroy the wide moats of legacy software companies. And Adobe is actively navigating a highly delicate existential transition to prove that fear wrong.
They are trying to pivot their entire legacy user base to new, unproven AI models, which makes the timing of this departure completely jarring. Let's look at the official narrative management tried to spin on the call, though.
Yeah, what did they actually say?
They claim that Shantanu is leaving to, quote, set the company up for its next decade of growth. He stated that he wants to pass the baton smoothly, similar to how Adobe founders John Warnock and Chuck Geschke passed it to him.
Okay, sure. That sounds great in a press release.
But I want to push back on that narrative. And I want you to view this through the eyes of an institutional investor holding $1 billion of Adobe stock. You announce a CEO departure without a named successor waiting in the wings.
Yeah, that's the real issue.
You trigger what management openly admitted on the call will be a multi-month search by a special committee. You are actively creating a massive strategic vacuum right in the middle of a period that their own chief financial officer described on this very call as a period of profound technological change.
It creates a debilitating lack of visibility. When an analyst on the call explicitly asked about the timeline and the reasoning, the response was basically that the search will take a few months and that Shantanu wanted to be transparent early in the process to allow the board to take full ownership of this election.
Which, again, sounds entirely reasonable in a vacuum.
But to a portfolio manager, that translates to, the captain is leaving the ship while we are navigating a Category 5 hurricane of technological disruption, and we don't even have a shortlist for the new captain yet.
We saw sell-side analysts immediately reacting to this. Citi put out notes explicitly flagging this leadership uncertainty as a primary risk. The market is looking at this multi-month window and pricing in the high probability that Adobe's AI execution might stall or pivot or lose precious momentum to nimble startups.
All while the C-suite is essentially playing musical chairs.
Exactly. Put yourself in the shoes of an enterprise chief information officer right now. You are about to sign a $50 million three-year commitment to integrate Adobe's new GenStudio across your entire global marketing department. Do you sign that contract today?
No way. You pause your spending because you don't know who is going to be running the vendor company in 6 months.
Right. And you don't know whether that new CEO might change the product roadmap entirely. That hesitation, that specific friction at the enterprise level is exactly what the market is pricing in.
The execution risk for Adobe just went up exponentially. And remember the context of their stock chart leading into this. Adobe was already down about 28.6% over the trailing 12 months heading into this print.
It has vastly underperformed the broader software space. The IGV software ETF was only down about 3.7% over the same period.
Investors tuned into this call begging for a reason to believe the AI transition was finally working, and instead they got a sudden transition of leadership.
Okay, so we have established the leadership vacuum at the top. Let's dig into the product reality and look at what this new, unnamed CEO is actually going to inherit. Management spent an enormous amount of time on this call pointing to AI as a massive tailwind.
They really hammered that point home.
But when you look past the impressive top-line engagement numbers, it looks less like a clean tailwind and much more like a very complex, margin-crushing phase shift in how they extract money from their users.
Phase shift is actually the exact terminology management used, and we need to unpack the mechanics of it. They presented a very robust, very aggressive set of bullish AI metrics to try and prove to the street that their thesis is working.
And we should acknowledge the scale of those metrics because from a pure engineering and distribution standpoint, they are staggering. Let's run through the bull case on AI adoption to see what is working.
Right. So they stated that AI-first ARR more than tripled year over year.
Tripled. That's huge.
Yeah. And Firefly, which is their proprietary generative AI creative model, surpassed $250 million in ending ARR. That figure includes subscriptions to the standalone Firefly web app, individual credit packs that users buy to generate images, and Firefly Enterprise deployments.
And they also mentioned Acrobat AI Assistant ARR grew roughly 3x year over year as well.
The top-of-funnel engagement, meaning the sheer number of humans entering the Adobe ecosystem, is just exploding. They surpassed 850 million monthly active users, or MAUs, across Acrobat, Creative Cloud, Express, and Firefly.
That is up 17% year over year.
Creative freemium MAU alone crossed 80 million, growing over 50% year over year.
Let's put 850 million monthly active users in perspective for you. That is roughly 10% of the entire human population interacting with Adobe software every single month. It is an insane distribution network.
And those users aren't just, opening a PDF and closing it. They are actively consuming intensive compute power. Generative credit consumption was up over 45% quarter over quarter.
Wow.
What is particularly fascinating from a technological standpoint is the modality shift occurring within that consumption. People are no longer just typing prompts to generate static 2D images.
They're moving to harder formats.
Exactly. Video generative actions were up 8x year over year. Audio generative actions doubled. Users are integrating AI much deeper into complex, multi-layered creative workflows. As a result, Firefly subscription and credit pack ending ARR grew 75% sequentially from the previous quarter.
So I've stopped you right there. That sounds incredible. You have 850 million MAUs, massive quarterly credit consumption, and AI ARR tripling. The duck is gliding smoothly.
Right.
The panic.
Well, here's where the argument for a clean beat completely falls apart. You have to dig deeply into the traditional legacy parts of the business to see the aggressive cannibalization effect that is terrifying the street.
Ah, the cannibalization.
Yeah. And the prime suspect here is the traditional Adobe Stock photo business. This was the major operational leak in the quarter, and management was forced to openly admit it.
What happened with Adobe Stock?
Their traditional standalone stock business experienced a significantly steeper and faster decline than they internally modeled. We are talking about roughly a $450 million book of business that is actively eroding.
450 million, that's not a rounding error.
No, it's a massive hit. And if you look at the mechanics of why, it makes perfect, brutal sense. In the old workflow, if you are a digital marketer and you need an image of, say, a golden retriever wearing a spacesuit for a campaign.
Classic stock photo request.
Right. You go to Adobe Stock, you search the database, you find an image uploaded by a professional photographer, and you pay a licensing fee. Adobe takes a massive, high-margin cut of that fee.
But in the new workflow.
You just open Firefly, type golden retriever in a spacesuit, use a generative credit, and create the exact image yourself in 5 seconds.
The CFO, Dan Dern, specifically noted that if you back out the drag from that traditional stock business, total ARR growth would have been approximately 11.2% instead of the 10.9% they reported.
But Wall Street is not going to just hand-wave away a rapidly declining $500 million revenue stream.
I have to challenge this dynamic, though. If Firefly ARR is growing 75% sequentially and hitting $250 million, isn't that just replacing the old stock revenue with new AI revenue? Why is the market punishing them for a transition they seem to be successfully executing?
Because the underlying economics of the revenue have fundamentally degraded. This dynamic validates the core, darkest fear of the AI scare trade.
Meaning investors are terrified that generative AI is not an upsell feature that allows legacy software companies to charge a premium. It is a deflationary replacement.
Exactly. Think about the margins. Serving a JPEG from a server for a licensing fee costs Adobe fractions of a penny.
Right.
Spinning up expensive NVIDIA GPUs to generate a net new video or image on demand requires massive compute costs. If users are fulfilling their creative needs with included AI credits instead of buying high-margin traditional stock assets, the market fears that Adobe is essentially trading high-margin legacy dollars for low-margin AI pennies.
Management tries to soften the blow by calling this a dampened short-term ARR impact. The market looks at the compute costs and calls it structural margin compression.
Exactly.
I look at this exact dynamic and I call it the freemium waiting room. Let me give you an analogy to explain what Adobe is doing to their user base.
Let's hear it.
Imagine Adobe used to own the only toll bridge into a major city. If you wanted to do professional creative work, you had to pay a hefty $50 a month toll for a Creative Cloud subscription. It was expensive, but it was the only way in, so they collected massive ARR. Now, generative AI comes along, and suddenly there are dirt road alternatives.
Oh.
To stop people from using the dirt roads, Adobe built a massive, beautiful, totally free superhighway right next to their old toll bridge.
Yeah.
This is their freemium strategy.
The Express and Firefly web apps.
Right. They use Adobe Express and web-based Firefly to attract 80 million people onto the free superhighway. They are doing a brilliant job driving record traffic, but they haven't figured out where to put the toll booths on the new highway yet.
They're just letting everyone drive for free.
Exactly. They're putting 80 million people in this freemium waiting room, hoping that eventually these users will exhaust their free credits, hit a paywall, and finally convert to paid ARR.
It is a massive deferred gratification play, which requires immense patience from shareholders. In the legacy software model, a business bought the software licenses up front, and Adobe recognized the recurring revenue immediately.
Instant gratification.
Right. In this new AI model, you get the user to try the AI, you let them play with the prompts, you integrate them into your broader ecosystem, and maybe 12 to 18 months down the line, their usage scales to the point where they upgrade to a paid tier.
Management explicitly argued on the call that this top-of-funnel strategy dampens ARR in the short term, but sets us up to deliver in the quarters ahead. But Wall Street abhors waiting rooms.
They really do. When you are a legacy tech giant trading at premium software multiples, investors demand immediate mathematical monetization.
They do not want to promise that 80 million free users might eventually pull out their credit cards next year, especially when the visionary CEO who designed the waiting room just announced he's handing over the keys and leaving the building.
The underlying growth algorithm has fundamentally elongated. Top-of-funnel traffic is at record levels, but the conversion cycle from a free user to a paid subscriber has stretched out considerably.
Because the free tools are just too good.
Partly, yeah. The individual creator, the freelancer, the small business, they're becoming much harder to monetize efficiently because the AI tools available for free, both from Adobe and its competitors, are simply good enough for most basic tasks.
which means we need to pivot our analysis. If the consumer and creative professional segments are battling this intense freemium fiction and core product cannibalization, we need to look at the enterprise segment to see if it can bail them out.
Because in traditional B2B SaaS architecture, the enterprise is the ultimate defensive moat.
Exactly. The switching costs to rip out enterprise software are brutal, the multi-year contracts are incredibly sticky, and the budgets are massive. Let's look at how Adobe's enterprise strategy is holding up.
This is where the narrative actually flips, and where we see Adobe's most compelling strategy to defend their moat. They are no longer just pitching themselves as a suite of creative tools, they are pitching themselves as the critical underlying infrastructure for the new AI-driven internet.
Let's examine those enterprise execution metrics because they are highly resilient. GenStudio, which is their end-to-end content supply chain offering, and AEP, the Adobe Experience Platform, along with their native marketing apps, each saw ending ARR grow over 30% year over year.
Growing 30% at an enterprise scale is an incredibly difficult feat. It requires deep integration into a client's daily operations.
They are successfully moving upmarket, signing larger deals. Enterprise customers with ARR above $10 million grew over 20% year over year. And management noted that they still serve 99 of the Fortune 100 companies.
The sheer scale of the data processing running through these platforms is mind-bending. They are executing over 35 trillion segment evaluations and 70 billion profile activations every single day on their Experience platform.
Let's contextualize 70 billion profile activations a day for you. That means Adobe is essentially tracking, predicting, and serving personalized marketing content to every single digital consumer on Earth multiple times a day.
They mentioned the recent Super Bowl as a stress test for their infrastructure, actually.
Oh yeah, those numbers are crazy. During the game, they handled 8 billion analytics server hits, managed 21 million concurrent streaming viewers, and processed 1.5 million video requests per minute. They are the invisible backbone for major global marketing moments.
But here's the critical pivot. It is not just about managing traditional web traffic or tracking cookies anymore.
And this brings us to a part of the earnings call that absolutely blew my mind, but the market seems to have completely glossed over it in their panic. We need to do a deep dive into the concept of the agentic web.
This represents a profound shift in consumer psychology and behavior, and it is an existential threat to traditional marketing. Management highlighted that consumers are increasingly bypassing traditional search engines like Google.
They aren't typing queries into a search bar and scrolling through 10 blue links and sponsored ads anymore. Instead, they're using large language models, LLMs, like OpenAI's ChatGPT, Anthropic's Claude, or Google's Gemini to discover information, engage with businesses, and make actual purchasing decisions.
They are treating AI agents as concierges.
And the data backing this up is undeniable. Adobe cited their own digital insights data, showing that during the 2025 holiday shopping season, retail traffic originating from LLMs increased nearly 7 times over the previous year.
7 times. That's a massive behavioral shift in just 1 year.
And here is the absolute picker that every marketer on Earth is staring at. That specific LLM referral traffic converted at a 31% higher rate and generated 254% more revenue per visit than traditional search traffic.
Let's explain mechanically why that happens. When you search Google, your brain is immediately on the defensive. You know the top 3 results are paid ads. You know the next 5 results are SEO-optimized spam articles designed just to capture your click. You have to actively filter the garbage.
Exactly. But when you ask a conversational LLM for a product recommendation, the AI synthesizes an answer and presents it to you directly. It feels like advice from an incredibly smart friend.
The psychological friction is gone, the trust is higher, and therefore the conversion rate to actually buy the product skyrockets. If you are a chief marketing officer and you see that LLM traffic converts 31% higher, your entire budget allocation changes overnight.
You realize that you must ensure your brand is visible inside the conversational output of these AI agents, which poses a terrifying problem for brands. Because if an LLM agent doesn't recommend you, you effectively do not exist to that consumer.
Right, you can't just buy a top-ranking ad slot in ChatGPT the way you can on Google.
So what is Adobe doing to solve this panic for the Fortune 500? They're actively building the enterprise infrastructure to sell to these terrified CMOs. They are pushing a suite of new tools: LLM Optimizer, Sites Optimizer, and Brand Concierge.
They currently have over 650 major enterprise customer trials underway for these specific tools. They're selling the pickaxes and shovels in the agentic web gold rush.
But we need to explain how an LLM optimizer actually works, because it sounds like magic. How do you force an AI to recommend your brand?
It comes down to a process called retrieval augmented generation, or RAG. When an LLM generates an answer, it often searches the live web to pull in current context.
Okay, so it scrapes the web before answering.
Exactly. Adobe's LLM optimizer helps brands structure the metadata on their website so that when the AI scraper comes looking for context, it easily ingests the brand's preferred messaging, product specs, and pricing. Adobe ensures the AI reads exactly what the brand wants it to read.
Then this ties perfectly into their broader capital allocation and M&A strategy. They have a pending acquisition of a company called Semrush, which is expected to close in Q2 or the first half of fiscal 2026.
Historically, Semrush is known as a tool for search engine optimization, or SEO. You use it to track keyword rankings on Google.
But Adobe's strategy here is much more ambitious. They are combining Semrush's tracking capabilities with Adobe's massive data platform to provide a comprehensive dashboard for brand visibility across own websites, traditional search engines, and crucially, LLM conversational outputs.
They want to be the single control room where a brand dictates how it appears to AI bots. It is a brilliant, necessary strategic pivot. They are trying to position generative AI not as a deflationary disruptor to their business, but as a massive new TAM total addressable market.
They're actively integrating their tools directly into the platforms that people originally thought would kill them. They announced integrations of Acrobat and Express directly into the ChatGPT interface. They are co-building foundational models with Google, OpenAI, and Anthropic.
Shantanu explicitly compared this moment to the advent of iOS, Android, and the web browser. Every time a new platform emerges where humans engage digitally, it is an additive opportunity for Adobe to position itself as the underlying workflow engine formatting that engagement.
I want you to really connect the dots here on the enterprise strategy. Adobe is no longer just selling a PDF editor or a photo retouching app. They are actively transitioning into a company that sells the fundamental infrastructure for global brands to survive the transition to the AI internet.
They are orchestrating the entire life cycle of a customer experience.
Exactly. You generate the creative image in Firefly, you manage the global campaign rollout in GenStudio, and you ensure an AI chatbot actually recommends the product to a consumer using LLM Optimizer. It is an end-to-end monopoly on the digital supply chain.
But, and there is always a massive but, when a stock drops 8%, if the enterprise story is this robust and the strategic vision for the agentic web is this clear, why did institutional capital hit the sell button so aggressively?
That forces us to zoom out from the internal product dynamics and look at the macroeconomic landscape and the forward-looking guidance. Because the market does not trade on the brilliant strategy you executed yesterday. It trades on the cash flow you promised to deliver tomorrow.
Let's do the guidance check. This is where the rubber met the road and where the market found the traction severely lacking.
Right. For Q2 FY 2026, Adobe guided revenue to a range of $6.43 billion to $6.48 billion. They guided non-GAAP EPS to a range of $5.80 to $5.85.
If you look at the segments, business professionals and consumers subscription revenue is targeted at $1.80 billion to $1.82 billion, and creative and marketing professionals at $4.41 billion to $4.44 billion. Those are solid sequential bumps.
But crucially, what did they do with their full-year targets?
They only reaffirmed their FY 2026 targets. They are continuing to target 10.2% total ARR growth for the year. They did not raise the bar.
And I need you to understand a fundamental rule of current software investing. In a market where capital is chasing hyper-growth AI infrastructure names like NVIDIA, a reaffirmation from a legacy software company is treated as a cut.
Let me say that again. If you don't raise your guidance, Wall Street treats it as a downgrade. Exactly why the reaction was so severe.
When your stock is already down 28.6% over the trailing 12 months, vastly underperforming every one of your peers, the market is aggressively demanding a catalyst. Investors needed undeniable mathematical proof of ARR reacceleration driven by these new AI tools.
They needed management to come out and say the freemium waiting room is emptying out, the 80 million users are pulling out their credit cards, and we are raising our full-year growth projections.
Instead, they got a flat reaffirmation, paired with a warning about a rapidly declining legacy stock business, paired with the legendary CEO suddenly stepping down. It makes Adobe the ultimate show-me story right now.
Pre-earnings commentary across the financial media flagged Adobe as the ultimate test case, the canary in the coal mine for the entire SaaS sector. Is generative AI a tailwind that allows you to charge premium prices, or is it a moat risk that commoditizes your core product down to zero?
The fact that shares fell 8% despite a perfectly clean beat underscores that the burden of proof remains incredibly high.
The broader sector impact cannot be overstated here. Software investors are broadly signaling their belief that AI-native tools will compress pricing power and drastically reduce the switching costs that used to protect these companies.
If a nimble startup with 5 engineers can build an AI model that does 80% of what Photoshop does for 10% of the price, Adobe's pricing power evaporates.
Management's counterargument is workflow integration. They argue that massive enterprises don't want disjointed, rogue AI models floating around. They want end-to-end orchestration with enterprise-grade security, full copyright indemnity, and strict data governance.
And mechanically, management is probably right in the long term. The multi-year arc of moving from a standalone creative vendor to an AI-enabled secure platform is operationally on track. They are building the exact tools the enterprise needs.
But the payoff curve just isn't steep enough, or arriving soon enough, to satisfy a Wall Street that demands quarter-over-quarter hypergrowth. The massive disconnect we've been analyzing today is fundamentally a timeline issue.
Adobe is playing a highly complex 5-year strategic game, and the market is grading them on a ruthless 90-day accounting cycle.
And this brings us to a fascinating inflection point for the stock. The market has violently repriced the equity based on a specific set of short-term fears. But when implied volatility spikes and traditional narratives break down in confusion, that is exactly where structural mispricing occurs and where opportunistic traders step in.
Which is the perfect transition into our signature Talk Ticker segment. Before we dive in, let me be explicitly clear with you. This is not financial advice.
Absolutely not.
What we are about to discuss is strictly hypothetical educational analysis of options mechanics. Do not take this as a recommendation to buy or sell any security. We are simply looking at the mathematical mechanics of the market to understand how volatility traders might attempt to exploit the chaos we just unpacked.
All right, let's step into the pitch room. Here is how a volatility trader looks at the structural mispricing we saw in the after-hours tape.
Set the stage for us.
We have a blue-chip stock that just dropped to roughly $248 based on fear of the unknown. We analyzed the options activity leading into the print. 114,000 contracts traded, which is roughly 196% of the average daily volume.
Massive volume.
And post-earnings, we saw a massive implied volatility crush. For those unfamiliar, before an earnings call, options premiums are highly inflated because the outcome is unknown. The Mickley options implied a plus or minus 7.0 to 7.7% move, which the stock perfectly hit with its 7.8% drop.
So the options market nailed the magnitude of the move.
Exactly. Once the numbers are released, the mystery is gone, and the premium deflates rapidly. That's the IV crush. The market currently thinks it has accurately priced in the broken growth narrative and the CEO transition risk at $248.
But the market hates a vacuum, and Adobe is about to provide a massive influx of data over the next 45 days to fill that vacuum.
That is the setup for the trade. We're looking at an agentic arbitrage and summit strangle. The concept is that we execute a long volatility strangle expiring in mid to late April.
Walk us through what a strangle is.
A strangle is an option strategy where you buy both an out-of-the-money call option betting the stock goes up and an out-of-the-money put option betting the stock goes down with the exact same expiration date.
So you are paying a premium for both sides.
Right. This is for you do not care which direction the stock moves. You only care that it moves violently in one direction to cover the cost of the premiums. You need velocity.
And why target mid to late April? What are the specific catalysts that will provide that velocity?
We have a confluence of massive binary events hitting in the next 45 days. First, management explicitly pointed to the Adobe Summit, their massive user conference scheduled for April.
Oh.
They heavily telegraphed significant new product announcements and partnerships regarding their GenStudio and LLM optimizer tools. If they walk out on that stage and drop concrete undeniable conversion metrics showing that a significant percentage of those 850 million free MAUs are aggressively converting to paid ARR, the stock violently re-rates upward.
The show me story instantly becomes a we showed you reality. Plus, you have the ticking clock on the CEO succession.
Precisely. Shantanu's announcement triggered a special committee search. The board knows the market is panicking. If they name a rock star successor, someone with deep AI pedigree who the street universally respects, that removes the governance overhang instantly.
That is another massive upward catalyst. We also have the Semrush M&A expected to close in Q2, which will finalize the narrative around their agentic web offering. But I have to ask, what if it goes the other way? What if the strangle pays off on the downside? What does the bearish velocity look like?
The downside catalyst is equally potent. If the April summit is a dud and they just present more freemium waiting room metrics without proving actual revenue conversion.
Or, even worse, if channel checks in Q2 show that the cannibalization of the $450 million legacy stock business is accelerating much faster than the new AI tools are growing.
Or if the CEO search drags into the summer, signaling internal boardroom friction or a lack of qualified candidates willing to take the job. If any of those bearish scenarios play out, the perceived floor at $248 falls out completely, and the stock searches for a much lower fundamental valuation based on terminal decline.
By going long volatility into April with a strangle, we are mechanically betting that the current $248 price level is highly unstable. We are betting that the market's current assessment is just a temporary way station, and the incoming wave of data will force a massive directional move. It is a pure play on uncertainty.
It is an aggressive, mathematically complex strategy, but it perfectly encapsulates the tension in this specific asset. You are not betting on Adobe's success or failure. You are trading the massive gap between the operational reality of the business and the market's psychological fear.
All right, let's reel it back in and recap the core tension we've explored today. We have a fundamentally strong, cash-printing legacy titan, deeply entrenched in the daily operations of 99 of the Fortune 100.
Yet, they are being severely penalized by Wall Street.
They are caught in the brutal friction of transitioning a massive 850 million user base from upfront high-margin legacy models to unproven freemium AI tiers, all while navigating the highly disruptive departure of a legendary CEO. The duck is paddling for its absolute life.
The structural foundation is undeniably there, the agentic web infrastructure, the enterprise workflows, the top-of-funnel reach, but the market's patience is zero. Adobe has to prove that AI is a highly profitable monetization engine, not just a massive traffic generator that burns compute, and they have to prove it incredibly fast.
Which leaves us with one final, slightly provocative thought for you to chew on as we wrap up. As we hurtle toward this agentic web, that Adobe is so desperately building tools for a web where AI agents do the browsing, the evaluating, and the buying on our behalf, does the actual quality of human-made creative content even matter anymore?
That's the real existential question.
If LLMs are deciding what products to recommend based purely on structured metadata and optimizer tools injected via RA, is the future of marketing purely about optimizing for machine consumption rather than human emotion? Are we still creating beautiful things for people, or are we just feeding the algorithm?
It is a question every creative professional needs to answer.
Thank you for joining us on this deep dive. Remember, the Talk Tickers trade ideas discussed are strictly for educational purposes, so keep your risk managed and your thesis sharp. We'd love to hear your input on the agentic web and the Adobe strangle pitch. Until next time, keep looking beneath the surface.